What is the market outlook for property investors and developers in 2020? In this series of 5 videos, I'm joined by 4 renowned property experts, and in each video, each expert will share with you their predictions for what the 2020 property market has in store for you. This is a must-watch. And you're going to want to be taking some notes and sitting down with a cup of coffee and watching all this series of 5 videos. Before we get started, remember, if you're new to this channel, make sure you subscribe and hit the bell icon, because we release new content each and every week, and everything is dedicated to helping you be more successful in property. Also, smash that like button, it really helps us out on YouTube. And also comment down below whether you agree or disagree with what's being said. Comment and let us know. Next up in part 4 is another good friend of mine, Andrew Roberts. Andrew Roberts started his career in the corporate world as a management accountant, advising businesses at all levels. He spent the last 20 years doing property investing. He runs the Great Property Meet as well up in Rugby. And here he is to share with you his views on the market outlook for 2020.
Three awesome talks. And I'm sitting here and going, what do they talk about? Well, I'll come at this from a different perspective, if I may. As an accountant, having worked at a senior level in a bank, and got headhunted into a law firm, so I've seen it from a property side because I grew up in the property trade, that was my father's industry. From a financial side in a bank, from a numbers side as an accountant, and from a legal side. Now, newspapers and the press work on headlines. Who loves the headline, property boom or property bust? It sells newspapers, the media love it. Do we love it as investors? We ignore it, generally speaking, but I do follow certain pieces of data that's published. Professional organisations where I have seen firsthand why data is published. And I follow RICS, Royal Institute of Chartered Surveyors, because they are a barometer on the market. The reason they're a barometer on the market, and in December they'll be publishing what I call the State of the Union Address, their forecast for the next 12 months and 3 to 5 year window. And that is important because that sets the tone for the valuers who come in and value buildings for those people who want to borrow money. So if you're not following that trend, that is an important trend to follow. Last year, they said prices will be flat or negative. Fiona's telling us she's buying stock cheap. Ranjan is saying he's buying stock cheap because we're on a downward cycle. RICS got it right 12 months ago. Why did they get it right? Surveyors have professional indemnity insurance. If the surveyor turns up just 20 grand more than the last person bought it for 3 months ago, the bank is going to smack them in a few years' time if that property gets into any trouble. I was there working for the solicitors, actually seeing how they identify cases of mis-selling or misvaluing. Therefore, that is a good barometer to watch, the RICS survey, because surveyors will jump up and down about their professional insurance premiums if they go up, because it puts them out of business. So that's a technical piece of data to follow and an indicator, and I believe the next report will be saying very similar to what the last one did. Prices will be negative or down. I talk to a lot of agents across the UK because I have stock across the UK. They are all saying stock is between 5 and 30% down. It's following a trend. They're seeing valuers rejecting or deals falling over because values have downvalued and mortgage offers not being honoured. Therefore, it's an opportunity for us as investors, if we've built ourselves a cash pile or managed our assets so we've got an unencumbered one, to buy additional stock at this time, because the cycle is down, and as Ranjan quite correctly says, Do you want to buy at the top of the cycle to wait to go down the cycle and come back up, or do you want to buy halfway down or towards the bottom because you've got less distance to travel before you get into profit? Going back to data and looking at trend lines, from the data I monitor, from many sources, the trend line is actually above pricing. Now this comes back to affordability. And if we look at affordability of property, and I've got youngsters, sort of Nina's age at the back there, who are aspiring to get on the property market, banks are now lending 5 times earnings to help you get onto the market. Do you think banks will lend you 10 times earnings and increase the term to 50 years if prices keep going up? Or do we actually need a market correction? So I believe we're in a position of market correction to balance that affordability, because we as investors are one section of the market and we account for around about 20% of the stock. You've got the social housing, which is another 20%, and the retail marketplace 60%. If 60% of the market can't afford, that disrupts the market, that disrupts prices. Therefore, we need to monitor data to see where we're at. Now, I monitor stuff on an economic macro and micro level, and Rod and I were talking a little bit earlier about this. My personal view is, as a UK, we're an island, and we like to think we're in control of our destiny.
Go Brexit.
Well, I agree, John. But are we? Because I'm looking at data, and I have multiple businesses, in property and out of property, as David said. And Germany is one of my business partners for my non-property business. Germany is in recession. Is that going to ripple over here? Of course it is. America is stuttering. China is stuttering. Globally, the markets are stalling. We look at our own economic data, and the most recent data was they were predicting a slight fall in numbers, but actually we've come out slightly above, which means we're not in recession in this country. However, we are teetering on the edge as a small island, and I would liken it to, there's a hurricane passing by and we're just caught in the wind as it passes by. We're affected by America's interest rates. America dropped its interest rates. Britain has said, we're going to hold steady. If we hold steady, that's good in one way but bad in another, because money moves across international borders. We as small people might not do this, but institutions move that money. And if money is flowing across borders, is it coming into the UK or out of the UK, David? How is it coming into the UK, and what's it being invested in? Is it for interest rate arbitrage, or is it into real estate? So we need to look at this data. And I would also look at the data about stock. Now, a really great indicator of stock and how well it's shifting at any particular point in a cycle is, are Kingfisher, Homebase and others doing well? At the moment, they're reporting sales up, and it was by a ridiculous amount of billions of pounds spent on home improvements, because people are choosing to stay where they are rather than sell. That's another prime indicator that stock is not coming onto the market. Therefore, stock that does come onto the market has more of a pain or a problem. Therefore, we can achieve greater discounts at this point in time, because you're only going to bring the property onto the market if finance is drying up because of worldwide finance, and interest rates are not going to move terribly out of line with global interest rates as much as we might think they would. They won't. Therefore, it's going to give us opportunities as investors. Now, looking further down the line, where does this take us? Well, Brexit, Brex not, Brex what? We don't know at this point in time. But what we can do is forecast. Are we going to go back and live in caves? Are we going to move our businesses onto market stalls again? Not really. Are people still going to go to work, have jobs, want goods and chattels because we find them appeasing to us? What we need to do is look at what is changing. Cycles are getting shorter. Technology is changing processes. I remember a long time ago, people said, when I was much younger and in my schooling years, that computers were going to make us all redundant. They now create more jobs for people than ever before. Industries have grown up and mushroomed. Who would have thought 10 years ago people could have a job as a social media marketeer or engineer, as they call them? There wasn't even an industry there. What we have to do is look for trends and spot opportunities and move there. But I won't go into John's territory of tech, because that's your field of expertise. But I believe we need to look at where markets are moving and forecast and predict. And that's one of the things I like to do, monitoring data and forecast and predict.
If you enjoyed this video, hit the like button. If you're not a subscriber, what are you waiting for? Subscribe, hit the bell icon. As soon as we upload, we'll let you know. And enjoy these. They're all dedicated to helping you be more successful in property. Happy investing!